Welcome to the Honolulu Hawaii Monthly Market Report. I'm Patrick O'Neill, Principal Broker Owner of Luxury Homes International, and we have our favorite guest, the founder and head of TZ Economics and Hawaii's leading economist, Paul Brewbaker. Paul, how are you doing today?
Doing great, thanks, Patrick.
All right, good. Really glad we could put this together.
Yeah.
Before we jump into the real estate statistics, wanted to ask you a few questions about the economy. And one is, I think, a topic you're passionate about, inflation. So there's been reports recently, fourth quarter U.S. inflation ending up somewhere around 3.5%, potentially 5%. Some economists are saying that's a good thing during a recovery period. So I have two questions for you. One, where do you plug Q4 inflation? And then secondly, is higher inflation good or bad during a recovery period?
Well, it's not unusual during a recovery period. And I think the best way to understand what we're seeing right now is that we are in a recovery period. So you'd expect to see, some pressure on prices. Typically what happens in an economic recovery, there's enough slack in the economy, right? Unemployed labor, industries that are operating below capacity that have the ability to just ramp up. Typically in an economic recovery, utilizing that additional productive capacity, putting people back to work, doesn't have inflationary, consequences unless there are, well, in the current case, breaks in the supply chain, so to speak, that unless there are, disarticulations, things that became disconnected that ordinarily would have been hooked up. And that happened in the global supply chain, partly because in the case of manufacturing capacity, not only did people reduce production for a moment last year, they shut down production. That is, a lot of industries just shut down for a couple months. And, starting back up is not like flipping a switch. Moreover, at least some of those industries shut down in expectation of a decline in demand, when in fact, demand went the opposite way. And the housing market is exactly one of those situations where a year ago in April and May, when we were hiding out at home, I was thinking, wow, this is going to be terrible for the demand for assets like housing. And in fact, everybody seemed to start day trading and looking for a better house in which to engage in day trading, or working from home, or schooling their children from home. And so you had this sudden increase in the demand for housing, primarily in detached dwelling single family homes, where people living in those houses were unlikely to put them on the market, at least momentarily, because of the uncertainties associated with the initial phase of the pandemic. So those disruptions, whether they were in a market like housing where we made a bet in the wrong direction, or for example, in home building, where a lot of suppliers of building materials thought that home building would go down. And in fact, there was an explosion in home renovation as people pimped out their house, for a home office. And those supply chains got disrupted, and notoriously in the automobile industry, there turns out there's a chip shortage that's affecting the ability to actually finalize the production, the assembly of a new motor vehicle. All of those things now, as the economic recovery gets some vigor in 2021, and inventories have been depleted by the rebound in consumption associated with the recovery. That supply chain is having trouble filling the pipeline with new merchandise, and so prices rise in many cases to clear markets where demand has outstripped supply. But there is likely to be eventually a catch up on the supply side, eventually a rebalancing to meet the sudden and in many cases unexpected resurgence in demand, or in some cases the sustained demand where a decrease had been expected incorrectly.
And this is
the year that it works out. And so this is the year you see a transitory inflation surge associated with it.
I see. And so do you sort of line up with those projections, mid threes up to fives for Q4 US inflation?
Oh yeah, I mean we're at 4% for Honolulu consumer price inflation now, as of spring of 2021, and we're at 4.5% for the U.S. I think the July number will be out, probably tomorrow. Now that we're talking about it, it may actually be higher between now and year end, but that's the other thing that's uncertain right now is, how long is transitory? How long is temporary? Because as recently as March, let's say, as recently as the first quarter of 2021, these inflationary pressures, while latent, while you could imagine that they were, going to be problematic, because you could already see the supply chain disruption. There are not enough containers, and the containers that there are in the wrong place on the planet, and the ship, it just, everything was out of whack. It was not until the spring that a lot of this was manifested, with some exceptions. I mean, you can look at commodities like so here's one of these edit points. I can show you the iron and steel and lumber producer price indices, and then I can show you the lumber futures prices, which are down 2/3 in the last 6 to 8 weeks.
Wow.
So whatever, the lumber prices tripled, and now they've fallen 2/3 from the peak at the end of May.
So the point of the reason to not really focus so heavily on this, it's transitory. It's just a matter of how long that period will be.
Yeah, you can cut out that whole part, by the way, but
oh, it's all staying in.
Well, I should show you the data. You got to see these data to believe them, because no, seriously, it's a motivation for me, right? Because I hear this stuff on the news and I think, well, that talking head is saying it, so I'm going to go look it up. And I look it up and I'm surprised to find, well, yes, the producer price index for lumber has been going up, at least through June. I don't think I have July yet, but I can see the daily price of lumber futures on the Chicago Mercantile Exchange having come down by 60 or 70% in the last 6 or 8 weeks. And I know just the difference between when the producer price index is calculated and published, and now I'm in August, so that's June, July, August, and what the spot market is doing today. We could look it up on our phone. You could see that in that particular case, right, the transitory nature of the disturbance is already apparent. Now, to be clear, lumber is still going to be more expensive than it was pre-pandemic, because the immediate resolution of these supply chain disarticulations does not completely resolve the problem of the fabric of the economy having been kind of torn full of pukas. Not to mention the permanent changes that are starting now to unfold, like the larger proportion of people that will be working from home, the smaller proportion of people that will dine out as opposed to having Grubhub deliver their food, right? Some of these things, the larger fraction of retail purchases that permanently now, post-COVID, will be conducted online as opposed to offline or in retail trade establishments, physical establishments, which have obvious implications for commercial real estate, whether it's office space or retail space or last mile fulfillment in the industrial commercial space arena. So anyway, I've gotten off track. There's a sort of a transitory component. There's a somewhat more sticky component to some of these price changes, and you have to be careful about translating either the former, the impulse, or the latter, the longer term, the permanent. It's called hysteresis, the temporary changes that turn out to be permanent. You've got to be careful about disentangling that from a rise in the price level in general, because for every increase in the price of in the value of the portion of the shopping mall that had been abandoned for all those years and now is going to be an Amazon distribution center, right? Something's happening over there. there's a bunch of guys who used to be strip mall tenants that are never going back in. And so the whole thing, I mean, it's just massive. It's
Right.
a
And this
massive
and this
shock,
was a
and
and
it's
this some
sorting
of these
out.
trends were pre-COVID already, especially with
Oh,
retail and
absolutely.
yeah.
You know, the move to online e-commerce, that was happening. But I'll tell you what, every restaurant has enables you to order online today.
That's right.
And that
That's
was
right.
not true pre-COVID.
That's
And as you
right.
say, when you think about it, why was that not true? Because that was the most obvious thing. I mean, if you just, what were we doing a year? You know, I did not know about Zoom until March 2020.
I don't think
What
any of us
changed?
did. Right. That's right. And now how could we live without it? It's just
How could we
crazy.
do this without? I'm like, oh my God. I was trying. People call me up and they go, hey, do you want to speak at a conference in Kona? And I
Yeah.
go, let me get this straight. I'm going to spend an hour driving to and from the airport here. I got my TSA hour, and then I got my, you know, hour on the plane both ways. And then I got my hour driving from that airport to whatever the venue is, which I have
Right.
to get to an hour early so I can do my 1 hour meeting. And by then, the whole day's gone. Or we can get on Zoom at
That's
11
right.
o'clock
It's
and
amazing.
have
No,
a
it's
1
great.
hour meeting. It's just,
So it's yeah, all these things that have come out of this. So Paul, I want to
yeah,
ask you one
yeah.
other question. You touched on this. We were having this past conversation. Jobs. So there was a
Yes.
UHERO report that came out that said at the peak of the shutdown pandemic in Hawaii, we lost 153,000 jobs. And
I
that
have no
as
doubt
of
that that's
today,
true. Yeah.
yeah, and as of today, there's still 94,000 jobs that have not been that have not come back.
Yeah, I was gonna guess 80, but I don't know the vintage of the report.
Yeah.
Um,
So I have two questions for you on that.
yeah.
One, why is it so difficult for employers to find help? We hear that every day, anecdotal stories. And then two, what is the impact of the economy? And we go out, it seems like the economy is just buzzing, but there's almost 100,000 people out of work.
Yeah. Okay, I am going to break to show you some slides here, but I have to
Okay.
go find them.
Yeah.
But yeah, as you can imagine, you know, it's all of the above. I mean, there's a lot of different moving parts. So it's not, for example, the fact that unemployment insurance is, you know, was amplified, although, you know, that might have been played a small role, and, you know, it might have played a role in some markets that you don't see
So that's what
everywhere
most
else.
employers will say when I
Yes,
say
I know.
why are you not getting it? It's
Drives
that
me crazy.
supplement, and then the magic date I
Yeah,
think is
yeah.
September 5th when that goes
So,
away. But you're saying
so
that's
yeah.
not really the root cause.
Let me put it as, so let's go back on
Okay.
camera here. Although, let me make
You're you're
sure I'm
you're
going to be
you're
able
on
to.
camera the whole time, so there's
Yeah,
no
yeah, I was
edit.
on camera. So what I can tell you from the literature, because people are doing the research on this, but um, there are early indications that that was never the case, but there are now new indications. There's a literature emerging which takes advantage of the fact that some states chose to withdraw supplemental unemployment insurance coverage unilaterally. They just said, in our state, we're not going to extend the benefits for another 3 months. So now you have a sample where in some states, they cut off the benefits early, and other states, they ran the benefits out until the statutory conclusion. And you now can observe in those two samples that there's no difference in employment creation. So the
Interesting.
problem to which you refer of a surprising challenge for facing employers in the face of relatively high unemployment, while it could have been partly a problem associated with the way that unemployment insurance, you know, was augmented, or the fact that it exists at all. We not only can we not really tease that out of the data right now, we have strong evidence because of the inability to tease that out of the data, you know, obviously, that other things have to have mattered, and which is kind of the whole theme of the post-COVID. Well, we still have COVID, but
Yeah.
the whole theme of the pandemic is the pandemic has changed a lot of things massively, and it's going to take us a while to sort them out. And it's important not to fall into the trap of seizing on the most obvious or intuitive explanation for things, because there may be something way more nuanced, but in the end, way more important.
So
let's,
while
yeah.
these studies are showing that it probably is not, what is causing that
Well,
shortage of
that's,
labor?
as I say,
Or is
that's
that
what we're trying to figure
no
that
one
out.
knows? Okay.
Let me give you a couple examples.
Okay.
First, let's understand what we're talking about in the data. So let's just look at a data set. So this is a difficult one. It's called the beverage curve. You've got, which is not what people drink while they're looking for jobs, but you've got, for a given unemployment rate, ordinarily, historically, we would associate, some number of job openings, right? And that you can see that there's an inverse relationship in history. In the 2000s, it was closer to the origin, right? It was, for a 6% or for a 5% unemployment rate, you observe about 4 million job openings. And then in the 2010s, that shifted outward a little bit. So this suggests, well, there's something happening over time. One of those things could be aging, right? The population is, right? The boomers are moving through and out of their prime working year, labor force participation years. And then the millennials, the younger cohorts in the 2000s were still coming up. In the 2010s, we're sort of entering the workforce for the first time in a material way. But what's extraordinary in the last year, from April through May of the 12 months recently concluded, how far out from the origin that those data have jumped. And so there's got to be more than just aging. Although, if you look at labor force, here are those employment numbers you were just talking about. So I calculate about 70,000 persons, but as you say, there's more jobs still missing because some persons had more than one job. If you look at labor force participation by age group, what you see is that the old dudes are not going back to work, and that the younger cohorts are, relative to labor force participation pre-COVID. So I've normalized
Paul,
these
I've got to
data.
ask you a question. On this
Yeah.
chart, are you
Yeah.
and I considered the young shredders? I just want to make sure.
Unfortunately, I am officially an old duffer.
I think I am too. All right. Okay. Got it. All right. Just wanted to clarify.
I call this the take this job and shove it factor, because when you get to my age, if some dude says, yeah, we need you to come back to work now, do the same thing for the same crappy pay without the benefits, I'm like, you know what? I just learned Zoom. Smoke this, hippie. Whereas, the young kids, and when I say young shredders, I'm talking about the teens. And by the way, here I've normalized, just so we're making straight comparisons with the pre-COVID period. Here's how things look in history. So when the old duffers, when the baby boomers were young shredders back in the 1970s, 50 to 60% of them as teenagers were in the workforce. 50 to 60% of boomers when they were in high school were labor force participants. And today that proportion is about 35%. Now, they're not just gaming, although some of them are. We do have a higher standard of living so that teenagers don't have to work in order to own a car today, like, what it was in the 1950s or 60s or 70s, let's say. So that, there's some good news there. And here's another bit of possible good news. The return to higher education has increased over the last several decades because of the nature of technological progress, which favors people who have developed their critical thinking and analytical skills and can use information technology to be more productive and harness those as a result of being able to harness those skills. So it's possible, and I think a plausible partial explanation for the fact that teenagers are less likely to be workforce participants, that they are now more likely to be engaged in acquiring human capital. That, right, they don't seem to be more likely to go to college, than a generation ago, and in fact, slightly less likely, which is of concern. But they're acquiring, for example, computing skills, right? They're learning to code as kids, that and spending more time on in computing platforms, albeit some of it in gaming, which is not necessarily not educational. I'm just saying we're in a different society today than 40, 50 years ago.
Yeah.
Nevertheless, right here at the tail end, where you see those V-shaped impacts of the COVID event, there is a sorting out across the age cohorts where a lot of the older people have just kind of given up. I was going to retire anyway. That's it. I'm done. I'm in an at-risk age group wherein, notwithstanding the fact that I've gotten vaccinated, because I'm sorry to have to even be able to say this, because so many people are not vaccinated, it's allowed the virus to evolve to where it now presents an even greater threat, even to those who got acquired vaccination, should they return to a customary workplace where the germs are shared, you know, across the open floor plan officeless environment with the half-height cubicles so you can cough over to your neighbor that we all ended up working in the last few years. So there's one set of issues that could be at work that has nothing, and there are others, you know, childcare, you know, maybe a lot of women had to leave the workforce last year in order to engage in not just child rearing, but schooling at home. And now, although, you know, the week that our COVID case counts on Oahu reached an all-time high, the Department of Education, in their infinite wisdom, decided to return everybody to school, including children under the age of 11 who can't get vaccinated, without a homeschool back. They don't even have a backup plan.
Right.
They just like assume it's not going to be a problem. So there could be a lot of parents that are keeping their powder dry, thinking, yeah, I'll send my kid back to school, but I can tell you, Garance Bombarance, in 3 weeks, they're all going to be sent home because of the Delta variant. And that's pretty much what's playing out right now this month.
Okay, well, let's get into the real estate statistics. So this is the Honolulu Board of Realtors market indicators that have just come out. And there's two big headlines in here, of course, which are the all-time price highs for homes and condos. So single-family homes up 20% year to date, 992,500, 7,500 short of Q, Dr. Evil.
$1 million.
You got to put the finger. Oh, it's this way.
Yeah,
okay.
sorry.
I got it wrong.
Got to get the shaka.
Okay, I like it. Okay. And then condos, of course, not quite as robust. Year to date, up 6.7%. So the question I have for you, number one, where do these stand in comparison to the long-term trend line and maybe to pre-COVID?
Right. Well, you know, you really have to look at it to, and now I have to go find it, which is what I'm doing here. Where the hell did I put that? It's you hit upon probably the most important factor, which is this distinction between a 20% increase on the single family side of the market and a 7% increase year to date on the condo side of the market. That's, you know, if it was 9% versus 11%, high single digits versus low double digits, that would sort of be in the ballpark. But 20 and 7 is far enough apart that it starts to get interesting. And so, as you say, if you put this in a little bit of historical context, you can really see how sharp the distinction is since the COVID event. Single family homes have rocketed upward and you know, have approached this $1 million mark, which we would have seen eventually anyway, right? If I just project out the path from the 20 teens now and make the heroic assumption that we would have stayed on the path until about 2023, 2024, we would have gotten there. What you can see here in both single family and condo data are that in 2018, both price series began to move off the path. moved below the path. They kind of got onto the off-ramp to the lower part of the bandwidth. Now, single-family home prices have rebounded and crossed through the lane there to this $1 million threshold, which prices have reached but not breached. And that's another important. You can see them starting to lose their vigor there, right? They're almost $1 million in May, and then not quite as much in June, and then almost $1 million in July. And it's sort of like, yeah, maybe that's the ceiling for now. Whereas condos, while they're up 7% against a weak period a year ago, on trend, they haven't been rising even at the 5% that they were rising pre-COVID. So they're more like on a 2 to 3% trajectory, even if year over year, the first half of 2021 is showing up 7% higher than the COVID impaired first half of 2020. That distinction is important to understand because it means that rather than a factor that's affecting the housing market as a whole, like low mortgage interest rates, right? Rather than a tide that raises all ships or all boats, there's something specific to single family that's not present in the condo segment. And clearly it happened after COVID. So it has, it plausibly is most likely associated with a specific characteristic of the pandemic. And among the things that come to mind very quickly are working from home, schooling from home. So there's the increased desire or preference for a detached dwelling or one that can be augmented, added to, renovated to expand the services, formerly housing services alone, and now housing and office services or schooling services that are in greater demand. And even though I know a lot of people, I have no doubt that the experts on this are correct, that there are important attributes of in-school education that make it desirable relative to the homeschool experience we went through last year. If you just separate the health and safety risk exposures for a second, there are socialization and other, psychological, mental health issues that have to be taken into account that are congenial to a child's upbringing in a school environment and that are absent in a home environment, particularly with smaller families today and so on and so forth. Notwithstanding that fact, there are advantages to online education. There are attributes of online education that can't be, for example, customization, the ability to learn at a different pace from the other 30 kids in that overcrowded classroom you're sitting in, which shouldn't be overlooked. And so, again, as we've talked about before here, some of these changes, there's a little margin of people that are permanently going to opt in for the remote learning, for whom those other benefits of in-school learning are outweighed by benefits in many cases they didn't know existed because they were compelled to use online learning temporarily for a year,
right?
Have now led them to choose to do so for another year or maybe for the remainder of for example, there's certain special needs tends to have a stigma attached to it, but there are kids that have special needs that require dare I say it, better education than they can get.
Right. So this is so all of this is part of what has led to this.
Yeah, I think
bifurcation of single family and condo.
A lot of people are talking about remote workers, and I think it's important to recognize that something definitely has happened in the workplace. That it's a work in progress, no pun intended, but it looks as if from about 5 to 10% of the workforce that worked remotely pre-COVID, we're going to end up in the neighborhood of 20 to 25% who will do so permanently in some format. It's probably much of it's going to be in a hybrid format, which involves going into the office 3 days a week or something like that, or on an ad hoc basis. But that's a completely different housing market from the one we had before.
Right. Okay. Well, let's shift gears over to take a look at closed sales volume. Before I do, I just want to give a quick shout out to the Luxury Homes International agents. Once again made the Pacific Business News top 25 largest real estate companies in the state.
Nice.
And yeah, we're one of the only, if not the only, that has appeared on the top 25 list for highest residential sales, highest commercial sales, highest development land sales. So great job, guys. Congratulations.
Awesome. Well done.
Yep. Okay, so moving now to closed sales volume. For single family homes, again, up 29% year to date. Condos up 58.4% year to date. We know it's coming off of comparison to a terrible year. But
sure.
how do these line up with the long-term trend line as far as the closed sales volume?
Right. I don't think, I'm trying to remember if I've actually got a graph of that I could illustrate. They're not far from the pre-COVID trend, but they are higher. So in addition to the preference shift to which I alluded on, maybe moving a little more towards the single family home segment, moving a little more towards suburban, ex-urban, and Zoomtown type of settings and away from the urban core, at least initially, there does seem to be now in the, as we're learning how to mitigate the pandemic and move towards a more endemic status for the coronavirus, sort of learning how to live with it, with its presence, and so people are busting the move, right? They're engaging in moves which they had deferred in the course of the lockdowns and shelter in place intervals of 2020. Moreover, I think because of the restructuring in many sectors of the economy that we touched upon earlier, that it's likely there are going to be substantial magnitudes of migration we have not customarily experienced on an annual basis. Now, you have to be careful about that because people have actually been leaving Oahu on net since 2016. So we have our own, Hawaii is in its own private Idaho of net out migration, and Oahu is at the forefront of that, although Kauai lost population more recently. But Oahu steadily has seen its population decline absolutely since 2016. And that is because more people are moving away from Hawaii than are moving to Oahu than are moving, I'm sorry, more people are moving away from Oahu than are moving to Oahu. In the old days, a lot of that was people moving from Oahu to the neighbor islands. And there's still a fair amount of that. That, in fact, may still dominate the statistics. But so large is Oahu to begin with in terms of population and housing, but also in terms of these migration numbers, that the state's totals are also declining. So it's gone from being a more Oahu-specific number where people leaving Oahu were ending up on the neighbor islands to something that's affecting the state as a whole. And it's an open question whether it's accelerated by COVID, because we just don't have, it's only been a year. We don't have the 2021 numbers and won't until next year. The 2020 numbers, they're typically mid-year estimates, which is almost too early to gauge. The odds that people made a decision after COVID really appeared in March, and then we entered, shelter in place in April and May. The odds that people made a decision in June or July to move because of that are relatively low. So I don't expect to see that manifested until we get into the early 2020s.
Okay, well, thank you for that. And I wanted to go back to the statistics. One other thing I wanted to ask you about. Months of remaining inventory, which is always a great way to look at the supply demand. This past month, 1.3 for single family homes, 2 for condos. We've always talked about market equilibrium around 4 to 5% when it's months remaining. I don't know where that came from, but my question to you is, obviously we're in a seller's market right now for single family homes.
Yeah.
Where do you kind of look at where there's equilibrium? Is it in that 4 to 5 month range?
So if you, it has been lower in recent decades. I tell you what, let me show you the recent data. I haven't updated these past June, so I don't have the July data. But if we were just talking about the late 20 teens or the mid 20 teens, 2.5 to 3 months of inventory, 2.5 to 3.5 months of inventory remaining was kind of the standard. In the old days, it was higher. I think part of this lower benchmark that we see in the mid 20 teens is a function of process improvement. That is, it's just people are better at, the title people are better and faster. The mortgage origination people are better and faster at what they do. And so we have seen process improvements. A lot of this is done algorithmically now, of course. A lot of it's done online. In fact, a majority of mortgages are originated online now. So possibly the new normal is, let's call it 3 months of inventory remaining. You can see when interest rates began to rise with normalization of monetary policy in 2018, let's say 17 and 18, those higher interest rates led inventories to pile up somewhat. So then we were looking at, instead of 2.5 months, 3.5 months. Two things happened in the last couple of years. The first was that the city doubled down on its enforcement of a 1989 ban on what I call undocumented vacation rentals. So many people for the last 30 years have engaged in, kind of an ad hoc vacation rental market, which was facilitated by hosting apps, both on the supply and the demand side, right? The hosting apps lower search and matching costs for the prospective occupant of these informal lodging units. And it appears as if a significant proportion of condos in Waikiki might have become participants in this black market, essentially, because officially they're banned. When the city indicated its intent to enhance its enforcement, that might have led some investors to exit from that ownership and use of the property. All I know is that in the middle of 2019, as interest rate normalization was reversed, as interest rates began to go back down, as mortgage interest rates began to go back down, single family home months of inventory remaining declined, but condos did not. Then came COVID, which if you were still holding a vacation rental at that point, and you went for 6 months with no tourism, no tourism and therefore no rental income, you were even more likely to exit. So condos, as you can see, piled up a huge amount of inventory, while single-family home inventories were being absorbed relatively quickly. Also, you have to remember listings did not. So listings just kind of bogged for a moment after right after COVID. People stopped listing to wait and hide out in their houses. Anyway, all these forces came together so that you had this bifurcation of months of inventory. They have never moved in opposite directions, at least in the last 20, 25 years. They always move together until those maybe 12 to 18 months beginning in the summer of 2019, and then punctuated 9 months later by the arrival of COVID. Now, you've seen them converge. They've gotten back to normal, gotten back to closer alignment. And you have the data in front of you, but you could probably see as of July whether they were, I'm guessing it's, 1.5 months for single family and
1.3, yeah, single family, 2 months for condos, right?
2 months for condos. So that's
right.
They're starting to converge again, and at least they're moving in the same direction. Okay. For a while they were moving in opposite directions.
That's right. And Paul, so one last question, kind of wraps all of this up. For the buyers out there that are thinking, I really need to wait to buy something, is there some sort of correction coming? What advice do you give them? And for the sellers who are thinking, maybe I should wait and sell next year, prices are going higher, Do you have any advice? And I know this is really getting into just projections, but
Yeah, I would not take anything I say right now as investment advice. There are just too many cross currents, but let me try to enumerate a few of them at the moment. The key here is that there's a tremendous amount of uncertainty, and for housing as an asset class, some medium to longer term downside risks. So the first cross current is that we saw a donut effect where demand seemed to move out of the urban core and towards the more North Shore, windward side, East Honolulu. I call them the Highlands, Mililani, Makakilo, West Oahu in terms of the condo segment, right? So the more affordable townhouse type format condos were also benefiting from from workers being enabled to avoid their commutes to the downtown. However, that creates its own sort of backwash, because as those valuations go up and the in-town valuations, and you can see it, just look at the neighborhood data in the Honolulu Board of Realtors, monthly reports, you can see the town kind of got left out. That means the town now is kind of cheap, relatively cheap, it sort of got out of alignment. And for people that are seeking a certain lifestyle or proximity to their employment, you're seeing this in Midtown Manhattan, you're seeing this to a certain extent in San Francisco. And I think you'll see in Honolulu kind of a backwash where people and younger buyers, for example, will be attracted back into the urban core. So which way is that current going? The answer is yes, both.
Yes. Okay, good. All right, we're going that way.
Then we get into the sort of medium to longer term challenges. First of all, the interest rate environment. We talked about inflation earlier. Inflation is a passing thing. It's not going to be a permanent structural impediment to economic recovery. It's not going to be the dominant factor in monetary policy making over the next several years, which now we can reasonably expect, because they tell us what their expectations are at the Fed, will involve relatively low rates for another year or two, followed by a normalization in which I'd expect the overnight rate around 2.5% in 2023 or 4, and maybe the mortgage rate up around, what does that work out to? 4.5%, let's say, maybe 4.25. It's not that bad. That's not expensive money at all. So that factor is not going to be the issue that blows us up. The issue that blows us up in the Oahu housing market has three facets to it. The first is we simply don't build enough of it. They don't let you, and you're not going to be allowed to. When you go down to get the neighborhood board to bless you, they're going to say, and there you go. Second is, so we built more housing in the 1920s than we're building right now in the 2020s with computers. So you have to reckon with that. Does that mean that there's going to be a continued shortage? Well, not necessarily, because if people are leaving the island, and at this point, that's kind of a momentum thing. It's not, give me a reason now why suddenly that will reverse itself in 2021 or 2022. One possibility is that remote workers will continue to be attracted to Hawaii. The people who didn't bust a move the first chance they had will, as things settle out over the next few years, come to a decision and an arrangement with their employers that they can live in Hawaii and work remotely elsewhere. That could still happen. But right now, the momentum is in the opposite direction. And here's the deeper problem. We're moving into a decade at which we're at risk of economic policy making in Hawaii being dominated by deindustrialization as a philosophy. So I'm talking about the Manini, the formerly $250 million biotech industry in maize genomics, that is now a $100 million industry, to something somewhat bigger, the $1.4 billion 30-meter telescope, which in 8 years of the Ige administration evidently is not going to be built, to tourism, wherein now the Hawaii Tourism Authority's official draft destination management plan for Oahu, which is half the market, is to reduce the number of visitors. So we just saw what happened to the economy when we don't have tourism for 6 months, or where we reduce GDP for by 8 to 10 percentage points, and reduce employment by 20 percentage points. If what we're talking about is an economy that never gets back to where we left off, which is what we are talking about, somebody's got to leave. I mean, I hate to say it, that's how that math works out. The houses do not. So that's the challenge. There's short-term opportunity. Do I think a house on Oahu really is worth, or Kauai or Maui, in the median, is really worth $1 million? Oh, hell yes. Because look at the rest of the country. It's still, relatively speaking, Hawaii is still valued at the same place it is relative to the rest of the country. But of course, they must have thought that in Detroit in 1975. If you de-industrialize, it's a whole nother economic trajectory that unfolds. And my concern is that the aspiration it's explicit now. People openly say less tourism, fewer tourists, reduce our principal export. Shamelessly, it's like the popular thing to say in an economy in which your principal export is declining absolutely, and there's nothing to take its place.
It's tens of thousands of jobs
just
that just will not be back. So, well, Paul, I can't tell you how much I enjoy our time together in these conversations. I really look forward to next month. It's always fascinating. And for everyone that's joined us, if you're interested in getting the full market report, you can send an email to info@luxuryhm.com. So that's it for today. We'll see everyone next month. And Paul, thank you very much, and aloha.
Aloha, Patrick. Thank you, bro.